welcome to this week's Taxes in Retirement Live. We got a good one this week. It's sort of one-on-one class, if you will. I'm going to be discussing the four account types, investment account types, which are regular after tax, tax deferred, such as IRA and 401k, Roth, and then I'll throw in HSA or health savings account. Let me start with the dad jokes before we get going. Let's see. Got some good ones this week. I'm proud of these. When my wife told me to stop impersonating a flamingo, I had to put my foot down because flamingos with their foot, they always got that one foot up. As I put my car in reverse, I thought to myself, this takes me back. Because reverse physically takes him back. And finally, my son Luke loves that we named our children after Star Wars characters. My daughter Chewbacca, not so much. It's a rough name for a girl, Chewbacca. Great for a Wookiee, not great for a girl, I guess. All right, so I see we have some people here, David and Cody. Hi, both. Thank you. So today's the four account types. Now, I'm saying that there's not only four account types in the world. These are really just the four that are most likely to be used in retirement planning. At some point throughout your life, not just in retirement. Retirement planning starts when you earn your first dollar, basically. Whether that's at 10 years old or 20 years old or whatever. But these are the main account types you're likely to come across. Again, after tax, regular brokerage accounts, tax deferred, Roth, and then HSAs or health savings accounts. There's other account types out there like a 529, which is specifically a college savings account. I won't be talking about that. So yes, that's a fifth account type, if you will. And I'm sure there's plenty others. But we're just talking about these four for now. The important thing to know, and this is why these get confusing, is that the account types themselves don't really dictate what you can or can't invest in. And I'll touch on that because there are some limitations, but don't think about those as restrictions of what you can invest. The account types, the significance of there being four account types is really how accounts in those types are taxed. That's really the main differentiation between them, as we'll see. So I guess let's get in it and see where this goes. I got some fun stuff tonight. I got some buckets. I got some Monopoly money. I got some physical stock certificates to play with. I don't know. Hopefully they'll add to it, and it's not just me playing with buckets and money and paper. But I think you'll find the use of this interesting. Yes, David Meyer is pointing out there's a whole bunch of other account types. Coverdell, UTMA, which is a uniform transfer to minor. That's when you open an account for a minor child. So yes, there's a lot more in four account types. Again, these are just really the retirement account types you're likely to come across. So let's start with the regular or after tax or normal brokerage. I refer to these things refer to this account type by all those names. And this is the default account type or ownership type, if you will. Think about this stapler that I own, I bought in the after-tax world. My house I'm living in, I bought in the after-tax world. After-tax just means whatever money you have, like your checking account, savings account, or cash you have sitting in a bed, that money if it was subject to tax, it's all been taxed already prior to you getting it. So think about like wages, for example. You get paid every week, every 2 weeks, whatever. In most cases, you have your employer directly withhold tax for you. So yes, literally that money you get each week or 2 weeks is after-tax money. If you don't have the employer withhold tax, you got to pay it in your tax return at the end of the year. So yes, during the year, maybe that money hasn't yet been taxed, but still fundamentally, it's all after-tax money, and that's money that you will have had to have paid tax on, prior to you getting it into your checking account. So easiest example, let's just assume you got that money through wages. So yes, taxes was withheld prior to you getting it, so therefore that money's after tax. It's sitting in your bank account, or it's in cash sitting under your bed or whatever. That's the default, how you own and how you buy stuff. Again, you go to buy milk, you're buying it with after-tax money. You go to buy a car, you're buying it with after-tax money. You buy a house, same thing. You have a savings account, for example. This is where the cups come into play. You have a savings account. This is after-tax money. You take, let's say, $100. Look at this stuff, top notch. You put that in your savings account, that's in the after-tax world. This account is the after-tax money. Tax-wise, what happens? Let's assume that $100 you put in, you want to see some magic? Wait for this. You get $20 in interest. Look at that. Oh, now $20 interest on $100. This is like some 1980 stuff I'm talking about here. These aren't realistic interest rates now. but whatever. Let's assume this savings account generates you $20 in interest. You have to pay tax on that interest in the year you get it, because this is in the after-tax world. And things that produce income or gains or whatever in the after-tax world, you have to pay tax on in the year of your realization of that income. So in the case of a savings account, again, I think you all know this, you put money in. If and when you get interest, you have to pay tax on that interest on your tax return. So this is the after-tax world. We're all in the after-tax world by default. What if you open up a brokerage account in the after-tax world? So this is like, I'm not partial to any particular custodian, but you go to Vanguard, you go to Fidelity, you go to Schwab, you go to TD, you go to wherever, and you open up a brokerage account. By default, this is what you get. You fund it. So let's say, where'd my money go? You put $50 in cash into your brokerage account. That cash was from your after-tax money, like it's from your savings account, let's say, into your brokerage. We're still in the after-tax world. So now you have $50 sitting in here. Let's say you use that $50 to go and buy yourself some stock. Look at this, real stock certificate. Bell South Corp. Doesn't exist anymore. This paper is worthless. Now it's just a souvenir, but this is or was a real functional stock certificate. So let's say you take that $50 and you buy yourself stock in that account. Boom, very good. Here's your stock. If and when you sell that stock, and let's say you sell it and the stock price doubles, it goes up to $100. You sell the stock, you get $100 now. You have a $50 gain because you originally paid $50. You got $50 more from selling it for $100. You have to pay gain on that. You have to pay tax on that extra $50 gain. And because this is the after-tax world, you have to pay tax in the year of that gain. So when I sell this, if I sold the stock this year in 2020, I'll have to pay tax on that $50. This is the after-tax world. This is a normal brokerage account. If that stock, while it was sitting in my brokerage account, was generating dividends and paying me dividends throughout the year, those dividends are also taxable in the year I receive them. If it was a bond, I don't have a bond in front of me, but if it was a bond sitting in this account and that bond is throwing off an interest payment every 6 months, every quarter, whatever, I'd have to pay tax in the year, tax on those interest payments in the year I receive them. That's the after-tax world. Where it starts to get a little confusing is when you buy like a mutual fund, you don't necessarily think about it, but you don't really need an account per se to buy a mutual fund. You just give $1,000 to Vanguard and say, buy me fund ABCDE. You now own that fund. There's not really an account. It's just you own the fund. You own that fund in the after-tax world. So functionally, that fund purchase, that mutual fund purchase, would still be considered an after-tax investment. May or may not be in a technical account, but it's an after-tax investment. The upside, the benefit of these after-tax brokerage or investments is that there's no limit on how much you can put in. I mean, the only limit is how much money you have to contribute, but there's no limit on how much money you can put in. There's no restrictions on how much you can take out or when. Now, there's tax implications, obviously, as I just showed. If I sell that stock that was in my account and I have a gain on that stock, there's going to be tax in the year of that sale. So that's one thing you have to watch out for with these after-tax accounts. What else? So yes, there's a tax events triggered in the year you sell them or the year you get something. That's after-tax accounts. Everybody good with that so far? All right, I'm just looking at some comments here. Layla asks, we're playing Monopoly. My 11-year-old daughter wishes. That's her favorite game in the world, and the other three of us in the house would rather get teeth pulled than playing Monopoly. And Mavis likes my high-tech special effects. Yep. I almost brought a little house too to show, look, you can own a house, a little Monopoly house in the after-tax world. Cody raises another point with these regular after-tax accounts, you can own them jointly. So you and a spouse can collectively and jointly own your account. You can't do that with these other accounts we're about to mention. Let me just check my notes here. I had to make meticulous notes for this one to make sure I wasn't, because it sounded like this topic was very simple on the surface, but the more I thought about it, I'm like, wow, there's a lot of holes we can go into when trying to discuss these 4 different accounts. So I'm trying to keep it all summarized, neat and pretty. Okay, so that's the after-tax world. That's regular or normal or taxable brokerage accounts, they're called. Next, let's talk about tax deferred. This is things like traditional IRAs, which stands for individual retirement accounts, employer plans like 401ks, 403bs, 457s, and TSP, which is the Federal Thrift Savings Plan. It's the 401k equivalent for federal employees. And then within that, there's also some other ones, like within IRAs, there's also what's called a SEP, single small employer plan, I think it stands for, SEP IRA. There's also something called the simple IRA. Both of those are IRAs that could be generally used for small businesses. There are limits on how big the business can be to use that, but they're kind of like real stripped down. They're not 401ks, that's a bad choice of word, but it's still an individual retirement account, but it can be set up by a small employer for the benefit of its employees, basically. And within 401ks, you can also have what's called a solo 401k. So if you're self-employed, you're your only employee, you can open a 401k just for yourself. It's still technically a 401k, but it's a little streamlined. There's also something called a simple 401k. So not to confuse it, but the point is all these things are tax deferred. And what does tax deferred mean? Unlike in the after-tax brokerage world, you generally get a tax deduction for the money you put into one of these tax deferred vehicles. So if you put $100 into a traditional IRA, assuming you qualify, and that's outside the scope of this video, we've done other topics and I have videos on it about how you qualify for the tax deduction. But assume you put $100 into an IRA and you qualify for the tax deduction, that's $100 less of taxable income you'll have that year. So in that sense, the money is pre-tax. The 100 you put in has not yet been taxed. That's the big benefit. That's the big draw of these tax deferred vehicles. Now they're not tax free, they're tax deferred. So you don't pay tax up front when you put the money in. You eventually pay tax when you take it out. You're just deferring the tax till some point down the road. You're kicking the tax can down the road is all you're doing. Let's see some comments here. Okay, good. So I have an example of an individual retirement account. This is a tax deferred account now. Seriously, where's all my money? I had a lot more hundreds in here. Anyway. All right. So, all right, let's same example as before where we had, what was it, $50? We put $50 into the account. The difference before in the after-tax account, we had already paid tax on our money before we had the $50 left. Now, with this tax-deferred IRA, we do not have to pay tax on the $50 we're putting in. We'll have to pay tax later down the road. I'll get to that. Let's now assume we buy that same share of Bell South stock, $50 worth in that account. Fast forward whether it's 6 months or 2 years, doesn't matter. We sell that stock just like we did in our after-tax account, and we get $100 in proceeds for that stock. We do not pay tax on that sale now. That's the beauty of these tax deferred accounts. No matter what happens inside this account, no matter what you buy, sell, when, or for how much, there's no tax triggered off when it happens. The only taxable event, generally speaking, unless there's other things, but they usually don't apply, you only pay tax whenever you take the money out. Let's say it's 30 years down the road in retirement. You pay tax when you take the money out. Again, it doesn't matter what happens inside that account while stuff's in there. It's only when you take money out. Make sense? So you then pay tax at the time. Unlike after-tax regular brokerage accounts, there are restrictions on who could put money in, how much you can put in, and when you're able to take it out. So again, outside the scope of this video, I don't want this to turn into a whole IRA rules and regulations thing, but basically you need to have earned income. You can only contribute if you have money coming in from wages or self-employment. Currently, you can only contribute $6,000 per year if you're under 50, or $7,000 if you're 50 or older, and that's it. And as far as taking it out, there's a whole host of restrictions around it. You can't take it out before 59 and a half. If you do, there's tax and penalty. If it's after 59 and a half, there's just tax, no penalty. There's a whole bunch of exceptions that I went through. I think it was last week or 2 weeks ago, how to avoid the penalty, but whatever. Point is, you're not taxed when the money goes in. Doesn't matter what happens inside the account while it's there. You're taxed whenever you take the money out. There's not many restrictions on IRAs. So the IRS says there's only two things you can't own in an IRA. One is life insurance and one is collectibles. In theory, you can own absolutely anything else inside your IRA, but there's a lot, you need to open that IRA somewhere at one of the major custodians, Vanguard, Fidelity, TD, Schwab, what have you. The custodians will almost always bestow upon you limitations on what you can own, and it's typically they're going to limit you to just traditional financial securities and investments: stocks, bonds, mutual funds, exchange traded funds, closed-end funds, which are another sort of exchange traded fund. They're going to limit you to that. They're not going to let you buy, cars inside of it or houses or whatever. There are some IRA custodians that do specialize, and it's called the self-directed IRA. There's a lot more flexibility and latitude in what they'll let you buy. So you can indeed buy property inside an IRA. The rub is it can't be for the benefit of you. Like, you can't put your house in there. You can buy rental properties in it and stuff like that, or investment properties, but you can't get direct benefit from it. That's a whole other video in itself. But generally speaking, other than life insurance and collectibles, there's no hard limitations about what you can have in an IRA, other than the custodian is going to limit you to stuff at their choosing, and it's usually going to be stocks, bonds, mutual funds, the traditional financial investments that I'm sure you're all kind of thinking of and aware of. Okay, David Folt's cup runneth over. Yeah, with $150 in Monopoly money. What else? Okay, now hold on to your seats for this one. I'm about to get a bigger bucket for this bucket. So this is one single account. This is an individual retirement account, otherwise known as an IRA, and it's tax deferred. What if you also have a 401k, which you can do? So 401k is going to be a tax deferred account you get from your employer, from working at your employer. You can have this in parallel with your IRA. This is something you set up individually. This is something you set up or your employer sets up for you if you elect to open it at your employment. These are both tax deferred. Just like with the IRA, it doesn't matter what happens inside your 401k. You put money in from your wages. That money grows. I put $100 in. It grows to $150 from interest. I buy some stock inside this account. I sell that stock later, and it gets me another $100 into my account. None of this stuff matters for tax purposes. Just like the IRA, whatever's inside the account doesn't matter what comes and goes, or how it gets converted from you use cash to buy stock, you sell stock to get cash, whatever. There's no tax implications as it happens. Just like with the traditional IRA, you're only taxed when you take money out. It's the distribution or the withdrawal of this $50 that you now have to pay tax on this $50, and potentially 10% early withdrawal penalty if you're under 59.5. Here's some magic. So you can have multiple types. IRA, yeah, there you go. You can have multiple tax deferred accounts. You can have a 401k from your current job. I don't have other cups here, but you can have multiple other 401ks from previous jobs. You could have a whole bunch of IRAs. There's nothing stopping you from having 10 different IRAs if you want to. You can have them that were funded by rollovers from other plans, or you can simply open up an IRA at every custodian you want to. No harm, no foul. So you can have a whole bunch of these tax deferred accounts. And again, no matter what happens inside each account, there's no tax implications. But think about it this way. All these tax deferred accounts are a part of one big fat tax deferred bucket. You can have monies, I want you to still see this. So you can roll over or transfer money from your 401k to your IRA, because all this stuff stays within this tax deferred bucket. So look, you can't see what's going on here, a little hocus pocus, but I'm taking $50 from my 401k. I'm rolling it into my IRA. You're going to say, but wait, money just moved from one little bucket to another. Isn't that taxable? No, because these are all still within this tax deferred, this broader tax deferred bucket, this broader tax deferred universe. The IRS doesn't care as long as your funds ultimately stay in the tax deferred world, meaning they go from one tax deferred account to another. That's all cool. Good. I have another bucket for Roth I'm going to show you in a little bit. That's when things start to get quirky, when you start crossing over from one big bucket to another. I'll just leave my buckets up here. All right, other comments? No. Sorry, just looking at some comments here. Parker says IRA, Pizza Hut stock equals good, Picasso painting equals bag. That's correct. Yes, again, IRA, you cannot hold life insurance or collectibles. So yes, you can own stock in Pizza Hut. That's fine. You cannot own a Picasso painting. That's a collectible. That's not fine. That's not allowed to be owned within an IRA. I don't know if anyone's ever tried to actually buy paintings inside an IRA. I guess in theory someone would have, but yeah, you can't do it, so don't. Mavis loves this so much. Mavis, I hope you're talking about the buckets, right? Yeah, I'm proud of that. I feel like a fifth grader playing with these buckets. I had this bright idea yesterday. Let me get some painter's tape and buckets and go nuts with it, and a Sharpie too. All right. The other thing to know about tax deferred accounts. So generally, as I mentioned, it's all pre-tax money. That's the underlying assumption. It's you put the money in, you do not pay tax on the money when it goes in. You instead pay tax when it comes out. Why am I using a fictitious air bucket? I got real buckets. You don't pay tax on the money in, you pay tax when the money comes out. It could get not difficult, but where it gets a little squirrely is you can put in money that you did already pay tax on into these accounts. That's where you need some record keeping. And when you do your tax return each year, there's a special form in there called 8606 where you keep tabs on how much already taxed money has gone into your tax deferred account, so that whenever you take money out, you're going to be taking out a prorated portion of that which is not yet taxed and that which has already been taxed. I'll leave it there for now. That can get pretty complicated, but the point is it's not always pre-tax money in tax deferred accounts. You can put already taxed money into these accounts. Like with your 401k, for example. Traditional 401k, you don't pay tax on the money you put in. But a lot of employers now allow after-tax contributions. Not Roth, that's something different that I'll touch on, but after-tax contributions. You can pump in additional money into your tax-deferred bucket, additional money that's already been taxed, but goes into your tax-deferred bucket. And there'll be record keeping and accounting of how much in this bucket is already taxed versus not yet taxed. I'm saying taxed a lot. I feel like this is probably getting confusing. I'm just super excited about these buckets, so sorry if I'm a little amped up about this. The other thing to know, I mentioned there's not restrictions per se. The IRS says you can't own life insurance and collectibles in an IRA. In a 401k, there's not really IRS mandated limits. I think it's the same restrictions that you can't have life insurance or collectibles. But in almost all cases, the employer who's administering the plan will limit your options to typically a few dozen choices of investments for you, because they want to keep it simple. There's a lot of operations and administrative processes to running one of these plans. They don't want you having the full gamut of tens of thousands of investment options. You're going to get a couple dozen mutual funds you can choose from usually. And we'll talk about that in November when Brian Williams is on. He's our resident employer plan specialist. We'll talk all about how plans are structured and what to look for in their fees and the administration and what have you. But the point is, even though the IRS doesn't really set a lot of limits, the employer plan will set a lot of restrictions into what you can invest in, and it'll give you a menu of here's your 24 things you can choose from, and that's it. And then the other thing to know with these tax deferred accounts is RMDs, required minimum distributions. The benefit of tax deferral is that, hey, great, I don't have to pay tax on this money I put in now, but you can't delay that tax forever. The government eventually wants theirs. So they force you to start taking money out. Now it's age 72. It used to be age 70 and a half. Starting this year, it's age 72. Once you hit 72, you need to take out at least a minimum amount every year for the rest of your life from your tax deferred accounts and pay tax on it. That's why they do it, because they're forcing you to start realizing that tax that you've delayed for however many decades. So that's kind of the downside of these tax deferred accounts is you can't delay it forever. Eventually you need to realize it. Whereas with the regular brokerage world, you can let the money sit there forever. You don't have to ever take any out if you don't want to. All right, comments. Layla asks, if you put after-tax money, can't you deduct it from your 1040? No, Layla, you can't. So that it wouldn't be after tax. If you deduct it, the deduction is what makes it pre-tax, if that makes sense. So if you are claiming a tax deduction for the amount you contributed to your plan, that's not after-tax money. That's pre-tax money because it's never been taxed. So by definition, if you put after-tax money to an IRA, that after-tax means you're not taking a deduction for it. So no, you can't take a deduction for after-tax money. If you do, that's no longer after-tax. That's now a pre-tax contribution that you made, Layla. You don't think you ever filled out those forms. How do I fix that? Check with your accountant. If you've done taxes yourself, it's going to take some work to backtrack. You're going to, we'll talk about it offline. The right answer is every year you made an after-tax contribution to an IRA, you should have kept tabs in Form 8606 in your tax return. You can try to just do one now to clean it all up and forget about the past, but the proper answer is you should file a 8606 retroactively for every year you made an after-tax deduction and did not account for it. All right, so that's regular taxable brokerage, and that's tax-deferred accounts. Let's now talk about the third bucket, which is Roth. Very similar to a traditional IRA, but the big difference is the money that goes in is after tax, so it's already been taxed. And then when it comes out, it's not taxed. So it's the reverse of an IRA. IRA is tax-free on the way in, fully taxable on the way out. Roth IRA is fully taxable on the way in, tax-free on the way out. And in both cases, traditional IRA and Roth IRA, again, it doesn't matter what happens when stuff is inside it. If there's any growth or gains or whatever, you're not taxed on it while it's inside it, whether it's traditional or Roth. You're only taxed in the case of traditional when you take money out, and in Roth, you're not taxed at all, assuming you meet the qualifications for it to be tax-free. I've done separate videos and lives on that. I won't get into it, but assume you meet those qualifications. All monies that come out are tax-free from Roth IRA. So that's the beauty of the Roth. You pay tax up front, get it out of the way. It's tax-free when you take it out. There's no kicking down the road. I'll show you this. I could show you the same example with the stock, whatever, but you get the point. You contribute money in, you buy a stock with it. That stock goes up, it doubles. You're not taxed on that gain so long as the money is still within the Roth IRA. You could eventually take it all out, tax-free down the road. That's the beauty of a Roth. And just like how you can have multiple tax-deferred accounts, like a traditional IRA, a Roth, a 401k, whatever, you can have multiple types of Roth accounts inside a broader Roth bucket. You can have a Roth IRA. I only had 5 pink cups, so pretend this says Roth 401k now, not just regular 401k. You can have a Roth 401k as well. You can transfer money, you can roll over money from your Roth 401k to your Roth IRA. Doesn't matter. Yes, you're hopping little buckets, but as long as they're all within this larger Roth bucket, it doesn't matter. The IRS is cool with you rolling over money from one Roth account type to another Roth account type without there being any taxes, penalties, whatever on it. Like IRAs, Roths also don't have many investment restrictions at the IRS level. Again, you can't invest in life insurance or collectibles. Outside of that, the IRS is cool with whatever. Practically speaking, though, any custodian you open a Roth IRA at, they're going to limit you to the traditional financial investments: stocks, bonds, mutual funds, exchange traded funds, etc. I never looked into this, but there may be those self-directed Roth IRAs, like there are self-directed traditional IRAs, that will let you invest in real estate and other sort of alternative, more off the beaten path, not traditional financial investment things. It's hypothetically possible. I don't know if it exists, but it may in theory, if you want to. And like traditional IRAs, Roth IRAs also have limits on who can contribute, how much you can contribute, and when you can take money out. The contribution amounts are the same. It's $6,000 in 2020. You can put in $6,000 if you're under 50, or $7,000 if you're 50 or older. But there's also income limits. Just like with IRAs, I didn't get into it, but there's income limits. If your income's over a certain level, you can't do a pre-tax contribution to a traditional IRA. You can do an after-tax though. With the Roth, there's also income limits. If your income's above a certain level, you can't directly contribute to a Roth. There's backdoor ways. I did videos in a separate live about it. That's outside the scope of this video, but just know that there are restrictions to how much can go in, who can put money in, and how you take money out. Now, I said before, the IRS doesn't like when you cross broader buckets of tax deferred to Roth or vice versa. You can't take Roth money and put it in a traditional tax deferred bucket. I don't think I've seen it happen accidentally. You want to try to avoid it. There's no upside to it because this is all money that you already paid tax on, and it's supposed to come out tax-free when you take it out, a Roth. Whereas this is the opposite. This is money you did not yet pay tax on, and when it comes out, you're going to be taxed. So you don't want to take Roth money that you already paid tax on, and it's supposed to come out tax-free, and mistakenly put it in traditional tax deferred, because now when you take the money out, you're going to be taxed. So you're double taxed. So you never put Roth money into traditional tax deferred. But you can go the opposite. You can take traditional tax deferred money and put that into a Roth. That's called the Roth Conversion. Do you like that? This was super slick what I just did. We talk about Roth conversions all the time, in the group, in these lives, in my videos, whatever. You can go from tax deferred to Roth, but it's a taxable event. You have to pay tax in the year you do the conversion of taking your traditional IRA and dumping its contents into your Roth IRA. That's assuming this was all pre-tax money. You have to pay tax on the conversion. If you happen to have had after-tax money in here, that money is not taxable when it gets converted into the Roth. So in some cases, you can crisscross buckets. You can go from tax deferred to Roth. You cannot and should avoid at all costs trying to go from Roth to tax deferred. That's a big no-no. Good. So that's 3 account types so far. Hold on, let's just see what comments here. So we went over the regular after-tax brokerage. We went over traditional tax deferred stuff. We went over Roth stuff. Dan Trainer's asking when to do a traditional IRA to Roth IRA conversion. That's the golden question. I mean, that's what we always talk about in the group. There's no single answer to that, Dan, sorry. At a high level, you want to do it when your income is lower than it typically is or lower than it will be in the future. That's one of the things to do. Or if you think your tax rates now are going to be lower than they will be in the future, that's another thing. There's no single right answer. It's all going to be facts and circumstances based on you and your particular situation, Dan, and a little bit of crystal ball magic about where we think taxes are going in the future. Parker says, should just get it all caught up at one time. Okay, yeah, so all right, Parker, I guess you're talking about the 8606 still. Yes, good. All right, final account type is HSA or health savings account. I don't have a bucket for this. I ran out of buckets. I have a sand pail. I should have used that. Anyway, so like tax deferred, the upside is it's tax free on the way in, but you pay for it on the way out. You pay taxes on the way out. Roth is the flip flop. Taxed on the way in, tax free on the way out. HSA is the best of both worlds. Tax free on the way in, tax free on the way out. Cha-ching. So HSA is health savings account. Sounds great, and it is, but not anybody can get one. You can only get one if you have a qualifying high deductible health plan. I won't get into all the rules of what qualifies, but as the name implies, the health plan needs to have not only have a high deductible, but there's other qualifications that needs to meet about copay, out of pocket and stuff like that for it to qualify. And if you have employer sponsored health insurance, you can ask them, is this a high deductible health plan that qualifies me for an HSA? If you buy your own insurance privately on like healthcare.gov or something, each plan will say next to it if it's HSA eligible, or you can ask if it is. So if it is, then great. Then you can open up an HSA. HSA doesn't automatically come with having a high deductible health plan, but if you do have a qualifying high deductible health plan, you can then go separately open a health savings account. Like the rest of these IRAs, Roth IRAs, there are contribution limits on it. I forget the exact amount. It's like $7,000 a year if you have a family, or half that if you're single. And then there's also rules on how you can take it out. You can only take the money out tax-free to pay for qualifying healthcare expenses. And here's the beauty of HSAs. So you put money in without paying tax. While it's in there, like those other Roth IRAs and IRAs, there's no tax implications while the money is in the HSA. If it goes up, it goes down, doesn't matter. It just sits there and does its thing. There's no tax to you as it's happening. And then when you take money out, there's also no tax if it's a qualifying medical expense. And that's, for the most part, any medical expense. You can use it to pay Medicare premiums when you're on Medicare, co-pays or out-of-pocket expenses for whatever, glasses, prescription drugs. That's all qualifying stuff you can take money out of your HSA to pay for. If you take money out and use it for a non-qualified expense, then there's tax and penalties on it, so avoid that. But the beauty is you can let HSA sit there for decades. So if you're in your 20s, 30s, 40s, 50s, you can be pumping money into an HSA every year. You could potentially be investing it aggressively. So the HSA administrator that holds the plan, they'll limit you to what investment options you can have, but there's generally going to be some sort of low risk fund, high risk fund, and stuff in between. So if you're only 40 years old, you can save this HSA for your retiree medical expenses 20, 30, 40 years from now. So you can invest real aggressive in your HSA, keep pumping money in every year, let it grow over the decades, and then save it, and then use it after you stop working when you're 60, 70, whatever, take that money out to pay for your healthcare expenses. Again, it could pay for your Medicare premiums. It could pay for out-of-pocket expenses, glasses, hearing aids. Something many people don't know, Medicare, traditional Medicare does not cover hearing aids, does not cover dental, does not cover vision, does not cover podiatry, unless it's like surgical and you smash your foot in an accident. It doesn't cover general podiatry stuff. There's one or two other surprising things that it doesn't cover. Now you can buy supplemental insurance that helps cover it, but the base Medicare doesn't cover things, hearing aids as well, that many people would think, well, folks in their 60s need these. I don't know why they're not covered. They're not. But point is, if you have an HSA, you can pay for those things if you don't have supplemental insurance that already covers it. So that's the beauty of an HSA. One big gotcha is once you are actually on Medicare, so this applies to people 65 and older, you can no longer contribute to an HSA. If you do, that's an ineligible contribution. You'll be penalized on it 6% per year on the amount of the ineligible contribution. You can still have an account that's already open and previously funded. You can keep that forever. You just can't continue to contribute once you're on Medicare, so 65 or older at that point. So watch out for that. That's a big gotcha. All right, let's go through comments. That's really all I have. I thought the buckets would be splendid, but it ends up felt like I was flailing buckets and cups around a lot, so I may have made things more confusing than it needed to be. Apologies for that. I thought the buckets was brilliant, but I don't know if it actually executed that way. All right, comments. Brenda asked, what happens to HSA in the event of your death? That's a good question. Right, so I didn't talk about beneficiaries with all this. I'll do that now. That wasn't on my agenda, but that's a great question, Brenda. All right, so let's start at the top. Regular after-tax brokerage accounts. What happens when you die? They go through your will, and they go through the legal probate process, and they will end up distributed to whoever your heirs are, your beneficiary, whoever's designated in your will as the recipients of your stuff. That's where it'll go. That's the regular after-tax brokerage account. The big benefit, and we've discussed this a bunch of times in the group, is step up in basis. Not to get too off track, but if you bought something for $50 when you were alive in a regular brokerage account, it's now $200. You have $150 of taxable gain that you have to pay tax on if you sell it, Brenda. If you instead don't sell it and just let that stock pass on to your heirs will inherit that at $200, and that $150 of taxable gain just magically goes away. No one has to pay that anymore. Big asterisk, the step up in gain is something that's on the step up in basis is on the chopping block as part of Biden's proposed tax plan. So who knows how to play out? I'm not saying it will or it won't, but depending how the elections go, it's quite possible step up in basis may get amended or outright repealed altogether, TBD. But as of now, regular brokerage accounts pass on to your heirs. They inherit the stuff at the value of those things on the date of your death. Tax deferred accounts. Because it's money you never pay tax on, Brenda, when your heirs receive them, that's all taxable income to them. They'll have to take that money out and pay tax as they take it out. Most beneficiaries now need to empty out the inherited account within 10 years. You could do it faster, but you have to do it at least within 10 years. There's some exceptions to that, but other than spouses and a few other select types of people, assume you have to empty out an inherited tax deferred account within 10 years of when you receive it. And again, all of that taking out of money will be fully taxable to the beneficiary, to the heir. That's tax deferred. Roth, really good in the eyes of beneficiaries, of heirs, because there's no tax to heirs. So you pay tax on the way in, money grows tax free. If you die, your Roth accounts go to whoever you designated as the beneficiaries. They do not have to pay tax on it. Like traditional IRAs, beneficiaries need to empty out inherited Roth accounts within 10 years, but there's no tax on that. So that's a good upside to Roths from an inheritance purpose. HSAs, not good to leave to heirs. Well, I mean, it could be worse, but so HSAs again are I think David said the trifecta or the triple threat of taxes. No tax on the way in, stuff stays inside the account and grows tax-free, money comes out tax-free. So there's like no tax, no tax, no tax, boom, 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 trifecta. That's for you, the account holder. If you die, I believe your spouse is able to inherit it and use it as his or her own and still be tax-free. But anyone else, it loses its tax-free magic once you die and pass it on to someone else. So Brenda, you have an HSA, you die, you leave it to your cousin. You have 50 grand in your HSA. That 50 grand would have been tax-free to you if you took it out during your life. That 50 grand passes on to your cousin. Your cousin now has to pay tax on all 50 grand when he or she takes it out. Not the end of the world. Again, it's free money to them, so you can't necessarily feel too bad for them that they have to pay tax on something that they otherwise didn't have in the first place. But from an estate planning and sort of wealth transfer planning perspective, HSAs are horrible things to plan to leave to someone else outside of your spouse. You can leave them to charities. Charities do not pay tax on that. So if you're charitably inclined and want to leave something to charity upon your death, HSA is not a bad idea. But it's all going to depend in the context of what else you have and what your estate planning and sort of legacy goals are to decide what's best to leave and to who. But anyway, yeah, HSAs are bad from an inheritance point of view, from a tax perspective. Brenda, good question. All right, so again, that's all I have. So feel free to, anyone else has questions, comments, jump in. Let me just run through this list here and see what else we got. Yep, so Pat saying you can reimburse yourself decades later for your medical costs while the HSA is growing. That's exactly right. So an HSA is unlike an FSA. What does FSA stand for? I'm drawing a blank. Flexible spending account. So that's something when you are employed, some employers offer it. It's an account you can set up. You can put a few $1,000s per year. I forget what the limit is. It's always changing. Of pre-tax money that you can use to pay for medical expenses, or there's a separate FSA you can have for dependent care expenses like childcare or whatever. The beauty is that that's all tax-free as well. The money goes in pre-tax, and assuming you use it to pay for qualified medical expenses or whatever, it stays tax-free. That's a good thing. The bad thing, unless it changed, you can't carry it over, or if you can only carry over a certain amount or only for so long. There's no indefinite life on FSAs, flexible spending accounts. HSAs there are, as Pat pointed out. You can have an HSA for decades and just let it sit there. Just because you have medical expenses now in your 40s doesn't mean you have to actually use the HSA to pay off those expenses. Let it sit, let it bake, let it grow and stay invested for potentially decades, and then use that HSA in retirement as tax-free source of money to pay your medical expenses at the time. Great point, Pat. Wow, a lot of comments. Sorry, I feel like I should start at the bottom and scroll up because I'm guessing some of you have already responded to other people's questions here. Parker saying, nice trick with HSAs. You can look back to prior years for reimbursements on legit healthcare costs. Yes, you can. You need receipts. Yeah, have receipts, assuming you get audited at some point. But yes, you can use an HSA to pay for a doctor copay from 5 years ago. As long as you have the receipt to document it, and if the IRS asks for it, you better have it. But yes, you can pay for historical expenses with an HSA. And Kenan saying, yes, you can carry over limited amounts next year to FSA. Yeah, I thought that changed. You didn't used to be able to, but then they started that you could, and it may just be for 1 year and maybe only a certain amount. I don't remember, but yeah, it's definitely not indefinite like with an HSA. All right, other comments or questions here. So Pat also saying HSA has no Social Security withholdings and contributions. Sort of, Pat. Yes and no. That is I don't want to call it a misconception, but sometimes it's true, sometimes it's not. So yeah, so I said one of the big benefits of HSAs is triple tax threat. Triple tax threat. Tax-free on the way in, tax-free growth, tax-free on the way out. When I say tax-free on the way in, I was just referring to regular income taxes. Depending what type of plan you have and how you contribute, that contribution can also be free from payroll taxes, Social Security and Medicare taxes. The only way you can do that is if you have the HSA opened through your employer, through your employer's health insurance plan that you have, and the plan is part of what's called a Section 125 cafeteria plan. That's crazy IRS speak. I don't want to get into what it means, but your HSA needs to be a qualifying Section 125 cafeteria plan. If it is, and you contribute into your plan through your paychecks, yes, Pat's right. That contribution is not only free from regular income tax, it's also free from the 6.2% Social Security tax, and 1.45% Medicare tax. If you have an HSA outside of work, so you're unemployed or retired or whatever, you have private health insurance, and you have an HSA you open up on your own, contributions to that are still income tax free, but they're not saving you any Social Security tax or Medicare tax. Because you're not working, you don't have to pay those in the first place. But the point is, they're not saving you like extra taxes on top of your regular income tax. You only save payroll taxes if you contribute through your employer and if the plan is a Section 125 cafeteria plan. Cool. Yes, good point, Pat. Thank you for bringing that up. And we show with a double exclamation point. Wow, super excited. I like it. Love the enthusiasm. Debbie asking, I heard there are RMDs on Roth 401ks, even though none on Roth IRAs. How can you avoid this? Excellent question, Debbie. So yes, if you have a Roth 401k, there are RMDs that start in the year you're 72. That assumes you leave the money at your employer. So let's say you retire at 65, whatever, Debbie, and you leave your Roth 401k at your employer, let it sit there. Yes, when you turn 72, you need to start taking required minimum distributions out of your Roth IRA, your Roth 401k. But it'll be tax-free, thankfully. So no harm, no foul. If you want to, just drew a blank. If you want to skip having to take RMDs altogether, you just simply take your Roth 401k, roll it into a Roth IRA, because Roth IRAs have no RMDs. Simple fix, right? So just take your Roth 401k, roll it to Roth IRA, done. You get around having to take RMDs, Debbie. There aren't many reasons, separate topic, and I think I have a live on this at some point, but there aren't many reasons to keep your 401k open if you've since left. One is the rule of 55 that we've talked about a bunch. If you leave that employer after or in the year you're 55 or older, you can take out penalty-free distributions for those 4.5 years until you turn 59.5. That's one benefit. There's some larger creditor protection with it, but if you're not in a litigious life, you don't have a bunch of rental properties, or you're not a doctor or something that you're likely to get sued, I don't know that should be a determining factor for people to want to keep money in employer plans simply to get more legal protection. But outside of those things, there's not a lot of upside to keeping money in old 401k plans, Debbie. So generally speaking, it makes sense to roll it out. Not always, but usually. And it can get you around RMDs in the case of a Roth 401k, Debbie. All right, let me just look at the last few comments here. Brenda asks, you have to have earned income to open an HSA and have high healthcare premium. No. So if you have an HSA through work, then sort of by default, you have earned income because you're working. If you're not working, so you're retired, let's say, and this is common, so you retire at, let's say, 60, you can't start Medicare till 65. You got this 5-year window, you need to get yourself some health care. Most employers no longer offer retiree health care benefits. It'd be nice if they did, but most don't. Federal employees still get it, some schools get it, handful of corporate employers still, but otherwise you're on your own. From the time you retire at 60 to when you start Medicare at 65, maybe you can get COBRA to extend your employer coverage for 1.5 years, but even then you still got 3.5 years of health care you got to cover. So let's assume you go buy private insurance through healthcare.gov, aka the exchange, or Obamacare as it's still currently called, but who knows, that may get dismantled soon. If you buy a qualifying high deductible healthcare plan, Brenda, and you're not working, you can still do that, and you can still open up an HSA and fund it. That just means that the money you're putting into the HSA is coming out of your checking account or savings or whatever. You do not need to have earned income to fund an HSA, Brenda. You do need the qualifying high deductible healthcare plan, but assuming you do, then you can open an HSA, and no, you do not need earned income to fund it. All right. What else we got here? June asking, can I roll over my Roth 401k into a Roth IRA and leave my regular 401k alone? Meaning not roll it over. Yes. Should be able to. May depend on the employer and what they allow. They may force you to take a total distribution of everything. They may not let you just cherry pick out your Roth account and leave your traditional tax deferred account. It's worth asking. Some places may, some places may not. June. I don't think there's a universal answer that applies to all plans in that case. I could be wrong, but I don't believe so. Art is asking your thoughts on keeping income low for ACA tax credits versus higher for Roth conversions. Yeah, that's a good one, Art. That's a balancing act. We went over that a handful of weeks or months ago in one of these lives about the ACA credits. I had a whole live session about that. If you're eligible for these premium subsidy tax credits and you're on, because you're on an Obamacare plan, those credits could be hundreds of dollars a month, thousands of dollars a year. I've seen it firsthand. That's a lot of money to give up. So you got to run a lot of projections and what ifs, but yes, it may be worth it to skip conversions so you can keep your income really low in those years to qualify yourself for the maximum credit possible. Not always the right answer, but depending how much credit you're getting, how much ACA credit you're getting, you may want to try to keep your income pegged as low as you possibly can, which means skipping conversions or only doing really small conversions because you don't want to jack your income up too high. Great point, though. A great question, Art. All right. Elizabeth adding in some info about, so federal military employees get a health insurance program called TRICARE. You cannot have an HSA with that. Aaron asks, if I have money in traditional IRA and want to move that to a Roth IRA conversion, do I still need to be employed having income at the time of the conversion? No, you do not. Anybody can convert anytime for any reason, however much they want. Doesn't matter if you're working, not working, young, old, whatever. The only thing to watch out for is you will be taxed on the amount of the conversion, Aaron. Assuming it's all pre-tax money you're converting, you're going to be taxed on it. But no, you do not need to be working. A lot of people I work with, and this is a very popular retirement planning / tax planning strategy, is after you stop working. So you stop working at 60, your wages go away. You don't yet have a pension, let's say. You don't yet start Social Security. You're not 72, so your required minimum distributions have not yet kicked in. You, in theory, have zero taxable income for the year or close to it. So you have lots of control where you get your income and monies from. So that's a real good window to consider doing conversions, because if you have no taxable income, you can do, 80 grand of conversions if you're married and pay only, not even 12% tax on the whole thing after your standard deduction, whatever. So those are good years to really take advantage of filling up the low tax brackets tactically with doing conversions or whatever. But yes, the point is you do not need, I got sidetracked. You do not need earned income to do conversions. You can do them whenever you want and however much you want, Aaron. But be aware of the taxes that you'll owe on it. Brenda says maybe roll traditional 401k into your Roth 401k in-house, then roll to an IRA. I'm not sure if you mean conversions, like a conversion from your employer plan to a traditional one, Brenda. All right. And finally, what else we got here? So it looks like a couple more comments here. Good. Okay, so Parker's just commenting the same thing. So it sounds like Parker's in the tax planning sweet spot. Aaron, I will be doing Roth conversions. I am retired, no salary anymore. Just be ready for tax hits. That's exactly it. So Parker, you have potentially zero taxable income, so you can do tens of thousands of dollars of Roth conversions if you want, and they'll be taxed at 10 or 12% only, which is awesome. Just have the money on the side. Be aware you got to pay tax on that. So have the cash around so you can actually pay the tax bill when it comes due, and state taxes as well. So I make this mistake myself. We're always inherently, it's implied we're talking about federal taxes. Keep in mind state tax impacts on things as well. Now, if you live in Texas, Florida, whatever, it doesn't matter because there is no state income tax. But for the majority of states, there will be tax implications on most of the stuff we're talking about. Now, granted, state taxes are a lot less lower than federal taxes. It's usually single-digit percent or low double digits. It's not going to be 20, 30 something percent like it is with your federal tax brackets. All right. Looks like that's it for the comments / questions, so I will leave it there. Thank you all. Hopefully the buckets weren't too much of a distraction. They sounded genius in my head as I was picturing me with cups and buckets, and as long as it stays here, you're good and whatever. But I think it may have got a little scattered with me throwing around pink cups and white buckets. All right, so that's that. Next week is a good one. This is a common topic and question I see, from clients and just throughout friends and family and Facebook world and whatever. How to choose between, if you have a traditional pension, regular defined benefit pension, and you're offered a lump sum in lieu of that pension, what's the decision process to choose which one's right? Well, there's no single right answer. Don't listen to the boneheaded advice on Facebook that says, well, the math is this, and if you can do this and that, and this is going to get you X percent. No, it's not that simple. You can try to boil it down to pure numbers. That's one data point. That's one decision point in your analysis. You can't make it purely a time value of money math quantifiable answer. There's other factors and considerations that need to get folded in. That's what we'll discuss next week. All right, that's that. So I will see you. Have a good week, and it's been a pleasure. Hopefully you enjoyed the buckets. Thank you.